Hey everyone, this is Mayhem Talking Markets. It's Monday, December 20th, and we're going to take a look at a couple charts here and just kind of get a little sense as to where we are in this market. And there's probably a lot more uncertainty than certainty as to where we are right now, but nevertheless, we're going to look at the charts here, and we're going to start off with Kathy Wood's ARKK, or ARK Innovation ETF. I love it, hate it. I don't really concern myself with the emotions surrounding the ETF. I've both been, supportive of some of the names in it during certain times of the market, as well as critical of some of the names that have been added to it because I hadn't been necessarily particularly thrilled about it. Things like Robinhood, for example. But that's neither here nor there. We're here to analyze a chart. So ARK has had a rather rough and tumble 2021. I think it's fair to say, right? It started off so strong. I mean, look at this. This is the beginning of the year right here, right? So we just ran all the way up from like the 120s all the way up to almost 160. And then had this rather precipitous fall from mid-February to early March. You know, this thing lost like 20%, 30% of its value. Looks like about 30% of its value here. Yeah, about that. And then we had a bounce. We made a lower high. We made a higher low. So we're kind of in this sort of consolidation, trendless kind of state. But per Ichimoku, we were below the cloud. So we're technically in a downtrend, right? We tried to break above the cloud. Couldn't. You see this? We tried here. We tried here. We tried here. Ultimately, in May, we had the growth apocalypse, I guess you could say. A lot of these stocks were drawn down rather significantly, and the flagship growth ETF, ARK, was no exception, revisiting levels that it hadn't seen since 2020. Now, what's interesting about this is you see a rather consistent theme here in the price action, whereas, we have a lot of trouble staying above the cloud and getting above the cloud, right? So we've seen resistance at the cloud here. We were able to make this break. June was a very good time to be in growth. If you were in growth from really the May bottom into June, some of these stocks doubled, others went up, 30, 50%. So that short little time frame from the May swoon to the June high was a very good time. Now, how many people timed that perfectly? Probably not too many, myself included. I didn't time it perfectly, although I will say I was loading the truck in May, and I was taking risk off as we were getting up to this level because it felt like we were exploring these old highs and weren't making a decisive break above them. Now, what we can see is that the cloud itself plays a pretty pivotal role with the way ARK's price action works. The Tenkin and the Kijun are certainly worth watching, and on this chart, the blue line is the Tenkin and the red line is the Kijun, so just something to keep in mind. So you could see the interplay with the cloud. That's really what I want to focus on. As we got from that May low to that July high, that was a pretty weak high. We could see that momentum started to fade and ARK prices began to collapse lower. But the top of the cloud acted as support. Now, one other thing I want to mention before we go further in time, you see this green to red move in the cloud here? You see this right here? This is called a twist, and it's very bearish. So, when you have constructive price action, the cloud is green. And when you have, when the Ichimoku maths essentially are forecasting the heightened potential for negative price action, you have the cloud twist and turn red in the way that I'm charting it here. So you could see that not only did we have that bearish cloud twist, we had multiple areas of the cloud tested as resistance. And it was only in June when it broke above. And when it did break above, July was a pretty sloppy month for growth. A lot of stocks got hammered lower. A lot of them lost part or all of their June gains. So you can kind of see that in the sideways violence here. And obviously, ARK as a proxy for all things growth is not 100% accurate. There's a fair degree of positive correlation, but doesn't mean that it's going to represent every growth stock, right? Some fared better than others. Some fared much worse, and some align with ARK pretty well. Nevertheless, we are using it to represent the space because it is one of the better benchmarks overall. So as we could see in July, we found support at the Ichimoku cloud. We were able to try to kind of stage a sloppy rally, a pretty weak high here at 126.25. And then we plunged back in the cloud with the bottom of the cloud kind of acting as a level of support. Breaking above the cloud, breaking back into the cloud, and really just sort of a consistent theme here with ARK. A lot of interplay with the Ichimoku cloud. And before we zoom out to the weekly chart where you're going to see even more of this, I just wanted to call your attention to one other thing that could be mildly encouraging for growth bulls. If you see the level that we are testing now on ARK, and we've tested since early December, it's obviously lower than the May growth apocalypse lows, but it does get us back to a level where we were at and where we had formed some support in late 2019 during October and November. And that's important because price seems to have some stickiness. There's memory in price action. And so some of these levels become important even as much as a year or more later. And one trader who does a price action analysis that's very familiar with this concept and very good at it is Miss Izzy. So, she talks about this a lot and finds price action that goes back on monthly charts years, if not decades, and it's still 100% relevant and important and even leads to being able to map out breakouts and price targets and so on and so forth. So just wanted to mention that. Now we're going to zoom out to a weekly chart, but one last thing I want to mention for you you growth bulls out there, and I'm pretty neutral right now, but I'm just doing the analysis for the benefit of everyone watching. You got a little bit of a positive cross on the full stochastics here, right? You also have a little bit of positive divergence, although it's hard to be 100% with this because it's not exactly a lower low or the same low, but it's pretty darn close. And we do have, a crossover, a bullish crossover potentially starting here. So it's something worth watching. If we can get some continuation above the Tenkin here and above the, and I know this is pretty light. I apologize for that. I'll adjust it soon. But they also have the S1 pivot level here. So both the Tenkin and the S1 pivot, and let's see if we can make that a little more clear, are acting as levels of resistance, right? And so we're going to make this, we're going to make those pivot points black here so you can see them a little better. So you see that, there's the S1, there's the Tenkin, and there's ARK being repeatedly rejected. It tried to fake a break above on Friday, wasn't able to hold. And you can also see that this S2 has been a pretty strong area of support for ARK. So it's kind of trapped in a range, right? Now, if you look at the volume by price, you can see it's sitting on top of a volume shelf, but it's also sitting underneath some pretty significant supply. So you've got support basically at the S2, and you've got resistance and supply at that S1. So these are areas that are really worth watching because essentially what it governs is kind of where we can expect buyers may come in, and if they don't, we have a signal if we were long this. And full disclosure, I'm not long ARK, but I'm just analyzing this for you. But, if you were long this and it broke below the S2, you want to get out. And if you were long this and it breaks above the S1, you might be adding to that position because you've got this bullish reversal building, right? So those are two things to watch. Now, let's go over to the weekly time frame because I think that there's some more interesting price analysis to be done on that weekly time frame. So you can see here, this is that same area where we saw a lot of inability to kind of get up off of its feet in ARK, right? So we had the March swoon. We rallied back higher in April. We had the May swoon, and the May swoon brought us back into the cloud and into a trendless state. And then it was only then, really, that ARK began to just spend a lot of time in the weekly cloud for 2021. And it was only in November, and now we're seeing in December as well here, that we've broken below that cloud. And why does that matter? Because that means ARK is in a downtrend on multiple time frames, right? It wasn't until November that ARK was in a downtrend per Ichimoku analysis. I know there's a lot of other ways to quantify a downtrend, but we're just using this technique for the purposes of this video. And then the other thing you could see is, wow, look at all that supply. I mean, geez Louise, there's a lot of trap buyers up here. So every time we churn through this level, you can see distribution. Because if you bought here, let's say you bought up here. Let's say you bought at 130, and then you went through the May drawdown. And you're like, good grief, this is terrible. Oh, I'm down on my money. I put in, 13,000. Now I only have 9,700. Oh, I can't get over this. I'm losing all my money. And then it goes back and you're like, oh my gosh, I made it. And they sell, right? And certainly you saw that. You even saw this bearish shooting star weekly candle here where it failed below the Kijun right at that point. And then it tried to retest it from below. It failed, and we went into the cloud. So there's a lot to do with the way that Ichimoku looks at price action that can show you kind of where positioning is centered, even though it's not necessarily focused on volume. It's really focused on just price action. But, you see this huge volume shelf here, and it acted as a significant level of resistance. For a minute, it was support, and since, it's really been an area of consolidation and resistance. And now that we've broken below it, it is a sort of large area of supply that bulls will have to conquer if they want to bring ARK back into an uptrend, because look, you got to get above this cloud. What's above this cloud? The top of the volume shelf. So you see the convergence of those indicators and why that matters? That's really important to pay attention to, because when you see convergent technical signals, it's telling you something with a greater degree of confidence than if you just see one. Now, the other thing that I see on this ETF on a weekly basis is, look here. This is the monthly pivot, right? So if this thing is going to try to get back into an uptrend, obviously it has to cross this year pivot here. If it doesn't cross the yearly pivot, then it's not able to prove to anyone really that, because bears aren't going to cover if they're looking at charts like this. They're not going to cover if it doesn't break above this level. Why would they? And bulls, a lot of bulls are going to be reluctant to buy if it can't break above here, because look, this also coincides with the low that we saw just around May, right? So we got to break above that level. And then just above this pivot, you do still have a fair amount of supply. Even where we are right now, there's a fair amount of supply. Now, obviously, when you get into the cloud, you could see that it's extremely large overhead. And I do expect that to be an area where we see, as we have previously, continued distribution. What that means is selling pressure. People who have been trapped in shares of ARK that aren't happy, if they get back to these levels, are likely to sell them. It's psychology. There's a lot of people, and I'm not blaming them or faulting them or anything like that, but there's a lot of people that get into trades at tops, and then they just love getting out break even. And it's one thing that explains some of the price action that we've seen. And my buddy who runs Nova Wave talks about this as well a lot on Twitter and on YouTube. The full stochastics, though, they aren't looking great, but you do see that a little bit of a crossover. We want to see them get into positive territory, but that's something that's worth watching. If we can get above 20, I'd be a little bit more encouraged. But nevertheless, we do see some encouraging signs in ARK, but it is nowhere near out of the woods. So if you're bullish of this thing, be careful. We are in a somewhat unprecedented environment of volatility in terms of what we're seeing in growth since mid-February. These things have been drawn down 30, 50, 70%. Some of these things have been beaten down even further than that. So, this ETF is sort of a proxy for some of the bloodletting that's going on, but it doesn't tell you the full story because its biggest holding is Tesla, and that's kind of holding a lot of the price action together and really boosting ARK up from where it would be otherwise. So, my recommendation, if you're in high beta rate sensitive, and this is not investment advice, it's just what I would do if I was in your shoes, or what I would do with my own money, I should say, is just be cautious, okay? If it's me, I'm not taking on oversized position here. I'm trimming in areas where I have good profits, because I've been buying some of these dips that we've seen very, very carefully with tight stops, and usually I'm hedging these positions with puts too. So, I'm taking a little off into strength. I'm buying a little bit into weakness because, again, we're in this chop zone. No direction has been decided. So you're just kind of going sideways and trading within a violent range. Okay. Let's take a look now on a weekly basis at the S&P cash. This is the S&P just traded during regular trading hours. And the reason that we're going to look at this is because this is a follow-on to the video that I did on, I believe it was Sunday or No, I think it was Wednesday of last week. Anyway, I want to follow on to the last video I did, whenever it was recorded. That's neither here nor there. The point is that the last video I recorded showed the weekly candle just barely caught the Tenkin. And I was saying that, this is a really key area because we had seen this area act as support during previous routes, and when it hadn't held, we usually would test the Kijun, right? And when we couldn't hold the Kijun, we'd test the cloud. And when we couldn't hold the cloud, look out below. That seems like a lot to take in. I get it. I'm going to unpack it. The Tenkin is the leading indicator. So, a lot of people use 20 and 50-day moving averages. I'm not saying it's at all the same thing because it's not. But think of the Tenkin as your 20. Think of the Kijun as your 50, and that the 20s you're leading, the 50s you're lagging, right? Or maybe you use the 8 and 20 or whatever pair you use. Think of it that way. The shorter moving average is the Tenkin. The longer moving average is the Kijun. Now, they're not calculated the same as moving averages, which is why they don't necessarily behave or look like them, but they are leading and lagging indicators. So that blue line, a leading indicator, when price crosses below that blue line, it means that it's vulnerable to further downside. Just like any other time price crosses below a support level. The next support level below the Tenkin Sen, or that blue line, is the red line, or the Kijun Sen. So we've seen that in some of these other episodes, like the October one, that Kijun was a pretty important level of support, right? As were some of these monthly levels, this being the R1. And here we are in December, and we've broken below the Tenkin. Oh gosh. So whatever are we going to do? Well, there's some chance that we may end up testing that Tenkin. And that's right now at 44.88.48 in cash. That sure is a lot of 4s and 8s. So if we do test that level, and this is weekly, so it's very important to remember, this is not like what happens on a daily close. This is really what happens on Friday's close, and we don't have a Friday, so this week it would be Thursday's close. But really with these weekly candles, and I see a lot of people going back and forth on this, in my mind, from really kind of like old school technical analysis, you really want to look at weekly candles on weekly closes, and weekly closes are going to be the last trading day of the week, right? So we can't conclude anything from this yet because it could still close the week above the Tenkin. We have had some fake breakdowns, and fake breakdowns, I got to say, they're bullish. You want to see a fake breakdown? Here, let's look at this one. March, fake breakdown. 37.23 was the low. And what happened? It zoomed right higher, right, above the Tenkin during that weekly close. And then what happened the next week? Touched the Tenkin and moved higher. So those fake breakdowns can be really bullish. Here's another one. This was supposed to be what probably bears thought was a continuation of this breakdown. And instead, we moved quite a bit higher. So I think it's important to pay attention to that. Time frames really do matter. Now, on this weekly time frame, the S&P 500 is, you guessed it, we're above the cloud, so we are in an uptrend. And that's important because there's a lot of people saying the bull market's over, the Fed's tapering, oh God, we're all going to die. And, I have to admit, I think it's a little over the top. Is the volatility disconcerting? You betcha. I don't think, anyone but traders are really having a good time right now. Investors are looking at this stuff and they're like, what the heck is going on? Pension fund managers and other professionals, they're not having a good time. I've talked to people in the industry. They don't like any of that stuff. I mean, they're not. There's a lot of funds that were up really good year to date, and they've lost a lot of it. Some are in the negative now, depending on what sectors they're focused on. No reflection on these money managers. They're not traders. This is not the environment they cut their teeth on. And no disrespect to any of them. I mean, some of these people are very smart. This is just not their market. I had one friend who had a fund that was up 40% year to date, and they've gotten hit so hard they're only up about 14% year to date now after what we've seen really since September, right? And none of these guys are dull knives in the drawer. These are all some of the brightest money managers and mentors and people from the industry I know. So if you're struggling with your portfolio this year, don't feel bad because honestly, a lot of people are, and there's nothing wrong with that in the sense that it's a time to take a step back, learn what's going on, Why did your risk management strategy not work? What can you do better in the future? But it's not the time to give up, at least not in my opinion. I think that often is the case that when we're most tempted to give up, we're closest to achieving some level of success. So it's really important to just keep pushing, right? And obviously that doesn't mean don't take time off. If you're exhausted and it's the holidays, we're 5 days from Christmas, take some time off, enjoy your life, but don't give up on yourself. The most important investment you can make in trading, in investing, and in finance in general is in yourself. And really that transcends to all parts of life. Always invest in yourself. So let's get back to the chart. The S&P shows a little bit of a bullish stochastic cross on the weekly. So that's encouraging. We also closed towards the highs of the day today. And, after hours, we're getting a little bit of positive action. But we're not going to talk about that because after hours is really only helpful if you're trading futures. If you're not trading futures, it's just more a barometer of sentiment. And by the time you watch this video, it's going to be completely different. All right. So let's look at the S&P now on a daily time frame. And I'm just going to zoom in. We were 3 years, 3 months. We're just going to do a year. And here we are. Now, what's interesting about this chart on the yearly is it's obviously quite a bit different than on the daily time frame for 1 year. It's obviously a lot different than the weekly time frame for 3 years and 3 months in terms of what you can see, right? There's more granular detail when every trading day's candle is painted. And what did we see today? Well, what's interesting about this year, first of all, here, we're starting the year. Here's January, the first trading day, so on and so forth. The S&P really hasn't spent a lot of time in the cloud until the back half of this year, right? Here's March. This was the sort of initial sign that all was not well in the world. And that rout happened around the same time that global central bank liquidity, the velocity of liquidity, I should say, not liquidity itself, but the speed at which it's entering the system began to peak. And around that time, you saw growth stocks, high multiple, small and mid-cap tech, SPACs, and all kinds of other stuff peak as well. It's no coincidence that the PBOC was also pulling back on the purse strings of their central bank liquidity and easing around the same time. More on all this in a little bit. So here we are, right? Here's March. Tested the cloud, broke above it. No one wanted to stay there for long. This volume shelf acted as support. And we don't go back to the cloud until September. I mean, look, this is just floating along. There's some tests of the Tenkin, there's some tests of the Kijun, but overall, all things considered, at the index level, it's pretty smooth sailing. Minimal drawdowns of any size, right? I mean, the biggest drawdowns we really saw are the ones that we're seeing of late. I mean, outside of this mess here, it's really September and November, December, or I should say September, early October, and then late November, early December to mid-December now, late December, that's been kind of choppy. And when we got into September, not only did we get into the cloud, and we found some support there at the bottom, and we kind of tried to break out. We had this fake breakout. Obviously, a fake breakout's really bearish when it fails, and it did. And then we got below the cloud, and there was a little period of time where the S&P was technically flirting with a downtrend, right? And there was a lot of people, justifiably concerned about the trajectory of the market. Now, we were also testing some levels that we had been in previously, so there was ample support to explore. We were also at that time, with plenty of potential appetite below us. So when I was going through this time, even though I was looking at Ichimoku and was a little concerned, I was also feeling just a little bit opportunistic because I felt like I could set some tight stops. And as long as we didn't break below some of these levels that we had seen previously, like, say, 42.38, 42.57, those are easy areas to manage risk, that it was time to be a little opportunistic, right? And we kind of painted this inverted head and shoulders, and we just zoomed along for the whole month of October. Can you see what happened when we broke above the cloud? You really saw the chop begin to abate. Like, when we're in the cloud, it's really quite volatile. As we broke out of the cloud, there was a lot of sort of path of least resistance moving quite a bit higher. We saw the same as we were breaking above the Tenkin, the Kijun, and as the Tenkin crossed above the Kijun. Just like the opposite happens when the Tenkin crosses below the Kijun, that's a pretty bearish sign. And you're familiar with the 50-day crossing below the 20-day and vice versa. It's that sort of same kind of sign. I wouldn't call it a death cross, but it's certainly not something that promotes vitality in price. So here we are now. And what are we doing? We are exploring the cloud once again. And why that's important is you can see very technically, and I'm going to zoom in here just a little bit to kind of show you guys a little closer. Here we are testing the Tenkan, failing, testing the Kijun, holding, and then today we gapped lower into the cloud. We're off our lows, but where couldn't the S&P get above? It could not get above the top of the cloud. So that's important, because as we zoom out again here, we can also see that on a daily time frame, the full stochastics are pretty bearish. Momentum favors bearish price action. We also have a potential double top here. We cannot discount that. If we cross below, let's call it 44.95, that confirms the double top, right? And a double top of that size, I mean, I would want to say, hazard a guess, probably takes us to somewhere between 4350, 4300, possibly lower, right? I mean, it could get ahead of itself if sellers really get some fear into the market. You could see the 4200s somewhere in that range, because there's a lot in there tested. I mean, you can see this big volume shelf at 43, around 4350. That would be a big area of potential support that I'd be looking at first. You've got 4300 here. There's a bit of a volume shelf there as well. There's also a lot of price action that's happened in these zones. So suffice it to say, there are levels to watch, but for the rest of December, what I think is really important for us to watch, especially during these sort of illiquid weeks where price swings can be magnified, is this S1 level, which coincides with the bottom of the cloud. If we break below those both, we are in a downtrend, and we could see bears get a little bit more emboldened, and we may not see the kind of support that we saw in September, October, because we just have a little bit less participation in the market, less liquidity. Like I said, a lot of these senior trade managers, the people that run the desks, the people that manage them, they're out of the office. A lot of juniors running the ship now, a lot of algos running the ship now. And, you have the tax loss selling behind us. I mean, I think that contributed to some of this pain here, But that's institutional tax loss selling. You've also got institutions where their fiscal year ends at the end of September or October, depending on them. So you saw some of that tax loss selling in here. You saw another round of it here. I mean, that's not the only driver. There's obviously more going on. I'm just giving you an example of one of the drivers. But we also have, until the end of the year, retail tax loss selling and required minimum distributions for retirement accounts. And so that's another factor to keep in mind, that there is some supply that could still be distributed if those tasks haven't been completed. And remember that RMDs were suspended in 2020, so this is a completely different world that we're dealing with now that they're back online. And you have a lot of distributions from retirement accounts that have to happen, and the older people get, the greater their distributions become as a percentage of their total account. So it's just another factor to kind of think of in terms of overhead supply. So right now we have an S&P that is trendless, that is trapped in the cloud, where we know our resistance level is at the top of the cloud. It's at the monthly pivot. It's at the Kijun. It's at the Tenkan. So we've got all that to grind through to try to get back into the good graces of a bullish uptrend. And then at the bottom here, we have our support at the bottom of the cloud and at the monthly S1. So those are the areas that I recommend watching if you're trading this market or if you're investing and you're curious about trend. We're going to take a look at the Nasdaq here. This is the Nasdaq 100. So it's just really the 100 biggest companies in the Nasdaq market cap weighted to the biggest 5, which are about 40% of the Nasdaq. Amazing that 40 cents on every dollar you put into the Nasdaq goes to just 5 companies, right? So that's a thing, and it kind of creates a passive liquidity feedback loop that is only enhanced by things like quantitative easing, share buybacks, and passive investing being the dominant force in markets now. Nevertheless, this Nasdaq has been kind of trapped in this range for really most of this time period since late October, and certainly all of November and December. Now, for a while, it kind of looked like it had put in this little head and shoulders, and we had this fake break. Then we tried to break above that level. Of course, there's a lot of supply up here. You can see it with the volume. shelf. So a lot of trap buyers. I mean, look, people were really excited up here. A lot of people got really long up here, and they're looking for the exits. And every time we approach that level, you see some selling come back in, right? So that's part of it. Certainly not the whole thing. You also have that tax loss selling going on. You have a changing macro environment, whereas some of these more rate sensitive, higher beta tech stocks are not as in favor as the idea was supposed to be, that 2022 was a year of economic growth and rising rates and Fed policy normalization. Some of that might be forestalled or reduced because the Build Back Better bill wasn't passed. The global economy is already slowing, and it seems like we have a little bit more elasticity in our debt market now that there's not going to be that debt issuance from Build Back Better, and that would have happened at the same time the Fed was kind of beginning to withdraw policy. So it's also interesting to think about Build Back Better in the sense that there's going to be that much less resource utilization, that many less jobs in the market, and therefore that much less inflationary pressure in the labor market and within demand and within putting pressure on supply chains. So I think that's another area that's important to keep in mind. The failure to pass this bill from a market-centric perspective is not necessarily a bad thing. In fact, there's some silver linings. Another one that Goldman Sachs mentioned is they downgraded Q1 2022 GDP from 3% to 2%, was that they felt that corporate tax hikes are off the table probably indefinitely, which I agree with. And quite frankly, with all the stuff that was in this bill, and I don't even want to get political, but IRS surveillance and corporate tax hikes and lots of giveaways to special interest groups, it's probably better it doesn't pass and they try to look at something that actually would really focus on infrastructure. And that would probably be better for the market and the economy too. So, and also, just from a macro perspective, if you're passing something like that, it should be during a recession and not a works program that's happening late cycle. It's kind of bad macro to do things that way. But hey, we are where we are, and things are more political than logical. So the Nasdaq, I'm sorry, I didn't have the Nasdaq chart up there. We've got it up there again now. I went back to the S&P, I guess there. But yeah, so we could see, the Nasdaq's been trapped in this range. It got back into the cloud here. We're trendless. We've been trendless since Friday, unlike the S&P, which became trendless today. And we're retesting these lows from early December. Okay? And by doing that, we're also kind of seeing whether or not some of this area of supply, right? We see the volume shelf, whether that's going to be support. We see these previous levels that are areas that are going to both provide resistance and potential support. So it's really important to see how we act here. Are we going to take out this low? If we do, it's likely we break below the cloud, and then the last vestige of support that we really see from a pivot perspective is going to be S2, which is just right here at this level, just about 15,250, right? I think if we break below 15,500 or 15,400, which is really the bottom of the cloud, it's going to get real nasty, right? I'm not saying it's going to break that way, but certainly momentum favors that outcome. If bulls can't wrestle control from the bears soon, we could see some pretty nasty price action manifest in the Nasdaq and in the S&P. And so let's just zoom out, right? Let's do the same thing we did with the S&P. We're just going to look at this from a weekly perspective. We're going to do 3 years, 3 months. Okay. And what do we see? It's a little bit weaker than the S&P for a lot of reasons. What's one big reason? Look at momentum. It's not looking so hot. The S&P had a little bit of a bullish cross happening. You do not see that on the weekly Nasdaq chart. What's another standout? Look at how it's been testing and testing and testing the Tenkin. On Friday, it broke below the Tenkin. You can see it close below it. And today, it's testing the Kijun already. Now, if this is like previous episodes, that could be a good thing. That might be the end of the bleeding. But we need a reversal, and we need it very soon. We can't even go sideways because these averages are moving higher. So sideways price action would still lead us below the Kijun by next week, if not late this week. So if we can't hold that level, that means the yearly R1 level would become potential support. We've had plenty of price interaction with it. Below there, it is the cloud top and bottom, right? Which the Nasdaq on a daily time frame is already exploring. So what this means is on a daily time frame, the Nasdaq is trendless. On a weekly time frame, it is in an uptrend, but it's in sort of a uptrend of guarded health because it is already testing the Kijun. And you can see here we have some volume shelf support below us, but we also have a fair amount of supply, just in the range that we've been chopping along. We're going to look at the Russell now, and we'll just do a weekly and then go to a daily. I know this is kind of back and forth. It just makes it easier to change the charts around. So here's a Russell on the weekly time frame. This one is looking, and you know, for no, it's pretty clear to anyone who's been following small caps. The Russell is the weakest of the week of the major indices, right? The Dow hasn't been amazing, but the Russell's just been a catastrophe. So here we are on the Russell, and what do we see first and foremost, right? What happened to all the other indices in 2021? I'm pretty sure they appreciated in price. What's the Russell done? It's only up to like 10% year to date at this point. I think it's like 8.6% now. But look, I mean, once we got to that February high, we just haven't been able to really do much. We made one new high after that, really. Like, you know, we had a couple little inconsequential ones, but one meaningful new high. Notice all these other ones that it manifested never got us above R1. Isn't that interesting? How that yearly pivot level is such a powerful wall. And then we finally push above, right? We finally push above, and it was a fake breakout. Pretty amazing if you think about it. After all this consolidation for 8.5 months. All this bullish momentum pent up, all the people that had been patiently waiting in their small caps to show some signs of life in one of the most sort of narrow breadth markets in a long time where there's just minimal participation. And what happens? Not only does it not break out for more than a week, but it gives all of it back and then some. And this is really just awful to look at. I mean, you could see people's hearts getting broken with each subsequent week. Just, and then hope, and then nope. And this is the bottom of the range. Right now, we are in the bottom of the range that we've been in for 2021. And we are now on a weekly time frame, unlike the other two indices that we just talked about. We are in the cloud. The Russell is trendless on a weekly time frame, and it is downtrending on a daily time frame, which we're about to look at. We can see that the Kijun was a strong area of resistance here. That rejection again. So that's an area to watch if there is any positive price action. We've got the top of the cloud, we've got the Tenkin, the Kijun, and we've got the yearly R1. Those are all the weekly levels you want to watch in the Russell. And of course, you have very bearish momentum, but it seems to be waning. Let's look at a daily. Let's talk a little bit about what we've seen recently. So the daily Russell chart is, I mean, it's kind of a catastrophe, right? I mean, there's so many lines here with Ichimoku and the consolidation. I imagine it's not the easiest thing to see and to get all the granular details from. So for that, I asked the companies within the Russell to extend their apologies to all my viewers. Half kidding. All right, so here we are. We have just I mean, it's such a terrible looking chart. It's almost hard to look at, right? But here we are at the low end of the yearly range. Have we been lower? Certainly. In February, in January, we were around just over 200. But today, you know, we closed at 212, but the low of the day was 208, only 6 points less than 6 points away from that low. That's meaningful. That means really to me, if we break below this monthly S1 level, The small caps are hosed. I think it'll paint a pretty large rolling top, and we could see this thing go back with a one handle on it and plunge quite a bit lower. I mean, S2 would be just an initial downside target. The downward momentum, if this thing really falls out of bed, is significant. I'm not saying that to scare anyone. I'm not even a bear of this stuff. I mean, especially down here, because the other side of it is it could really rip. So let's talk about the bull scenario. Here we are. We could be painting a double bottom, right? If we can get off this level. Yeah, it made a new low, but we could have a fake breakdown. And if we really saw bulls take control and push this thing over the cloud, and I know we're in fantasy town right now, but it's not out of the realm of possibilities that we see a pretty strong bid from later this month through mid-February. It's a pretty seasonally strong time of year for the worst performing stocks, for small caps. So that's something that that warrants your attention if you're trading, if you're investing in the small cap space. Watch these levels. If the downside is taken out, if I was in those stocks, I'd be selling them all. That is to say, if we take out the lows of the year, if we take out this monthly pivot level of S1, I'd be out all my small caps. I mean, I don't really have many at this point anyway, but yeah, I mean that would be the last straw, because at that point, anyone else who's in this thing is either getting stopped out or is capitulating, and the people that are dip buying there are just basically averaging down, which is not how you want to invest, especially in a market that has given you no love for almost an entire year, right? We're gonna take a look. We're gonna do a couple more charts. I hope this is helpful to everyone that's watching. I plan to post more of these kinds of videos, and I really want to try to talk more about different forms of technical analysis. I'm also going to do videos with macro charts, and we're also going to talk about current events in some of these videos, just to kind of go through what's going on in the news cycle. This video I wanted to be more focused on charts, but we might talk about some other things in a minute here. Right now, we're going to look at the TLT. This is the 20-plus year Treasury bond ETF. And that means that it's all of the longer duration stuff. So it's the 20-year and the 30-year, really, right? 20 years is kind of a newer bond, too. I don't know if a lot of people are aware of that. But the 20-year bond has not been around that long. It's really a 30-year bond that's been around longer. So TLT is typically a place where money runs to when it is either scared, when it is concerned about the viability of economic growth, or, in more normalized times when it is in search of yield, although these days, you don't really get much. On a weekly time frame, the TLT is in a pretty strong uptrend. It today tested the Tenkan, and it held it. We can also see we're above a pretty key area of volume shelf here. We're above the Kijun. We're above the monthly pivot. So the 20-plus year TLT ETF is constructive. And that's good. That's good. The 10-year, similar picture. You have a pretty nice little double bottom here, too. That's the 7 to 10-year ETF. It's mostly seems to correlate with 10-year price action. And, you can see that this thing is in a pretty strong uptrend. It's above all these key levels. There is certainly some supply here, but it's not insurmountable. So we're really watching this R1 level as resistance. We're watching the Tenkan, the Kijun, and the monthly pivot level, as well as the cloud top as potential support. Look at corporate debt. Totally different picture. There used to be a correlation, a stronger one, between treasuries and corporate debt, and that's beginning to break down because the presumption is that rates are normalizing, policy is tightening, and liquidity will eventually be drained from the system, and therefore it will become more difficult to finance corporate debt. Why does that matter? Because there's thousands of companies that are pretty much insolvent with normalized financial conditions. If the abundance of liquidity and its cost wasn't as affordable as it is now, thousands of corporations around the world would be insolvent. These are companies that don't make money or are highly leveraged or both. And that is a big risk that Scott Minerd of Guggenheim has elucidated. He says that that could be the driver of a recession in 2022, in late 2022 or early 2023, which correlates with the same research that I've been doing, where I see a number of macro risks, including corporate debt, becoming a bigger driver of a potential economic slowdown or recession later next year or early the year that follows. So watch LQD because it has a correlation with risk assets. When you're, when you're watching stocks, you want to know what does it cost for these companies to finance themselves if they need to issue debt. Well, LQD is a reasonable proxy for higher grade, investment grade corporate debt, right? So it gives you a sense as to what the appetite for that debt is. And that's important. It's important to watch.